Hello, and welcome to the Moss Adams presentation of SOX Squared, Uncovering Additional Value in Compliance. Before we get started, we have just a few administrative items that will improve your experience today.
Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
It is my pleasure to introduce today's presenters. Erin Krivanek. Erin has practiced public accounting since 2009. She specializes in internal audit, SOX compliance, and controls-based consulting for financial and information technology processes, helping clients identify risks, document and test their processes and controls, perform gap analysis, and develop remediation plans. Joining Erin is Mandy Santiago. Mandy's been in public accounting since 2006. She provides internal audit and SOX 404 consulting services, helping her clients with planning and scoping, risk assessment, control documentation, design and operational effectiveness, control remediation, and deficiency evaluations of internal controls over their financial reporting. Welcome to the program.
Good morning. So briefly to cover today's learning objectives, we'd like to describe how SOX compliance can be leveraged to add value in other business areas, to create value within process streams by integrating SOX with existing controls, and to establish more efficient and effective controls. We plan to cover several topics today, including an overview of internal controls, the COSO framework and your control environment, and what we are calling SOX Squared. This will include discussing specific control activities that can be implemented in any business environment to be able to improve effectiveness and efficiency of financial operations. Based on our experience, we have seen this to be true for both public and private companies. Think of internal controls as a map to help you reach your destination. In our case, it's reliable financial reporting. We may be required to comply with Sarbanes-Oxley, but really for any public or private company, there is a benefit to having internal controls to help you reach your objectives. We would like to share with you why we think that internal controls should exist in all businesses to help create efficiencies to reach your goals. As a quick background, I'd like to cover the different types of internal controls. Preventive controls would identify an exception before an error or a gap may occur. So this could include something like approving a journal entry before it's posted. Detective controls, these would identify an exception after it has already occurred. This can include a management review of account reconciliations where an exception is identified and then corrected after the fact. Monitoring controls, which include activities with management oversight of information. A good control example of a monitoring control would be quarterly management reports internal control gaps to the board of directors. Then we have compensating and mitigating controls. So these would be controls that could exist in the process to identify a gap later in the process. So for example, you may have a control that approves new vendors as they occur, but later in the process, there's also a review to ensure that all new vendors per the system were approved. So this might identify any changes that were made without the appropriate approval. Then we have directive or entity level controls, and this would include things that set the tone at the top. So it might include requiring employees to read and sign an employee handbook or providing a whistleblower hotline. And then another key element of controls is evaluating the risks and controls that exist. So we shouldn't have controls that create unnecessary additional work for really little to no additional risk mitigation. Balance is key. So we have our first polling question.
Yes, thank you, Erin. So please tell us a little about your organization. My company is, are you publicly traded, a private company, a nonprofit or government agency, or something not captured in this information? We want you to be sure and press submit to have your answer recorded. And anyone just joining us, we do have 4 polling questions today, and you will need to answer 75% or 3 questions to be eligible to receive CPE today. Bear with me. And we'll give this just another few seconds so that we can be sure and capture as many of our audience as possible. And we'll close the polls and take a look at our results.
Looks like we have a pretty good blend in our audience today. 38% publicly traded, 32% private companies, 15% not-for-profit or government agency, and 13 other. I think that's really great because the point of this webinar is really to focus on all companies and the opportunities to have internal controls to improve processes in any business. So many of you are probably familiar with the COSO framework, which is the most widely accepted framework to define internal control structure. Using the COSO framework helps companies effectively and efficiently develop systems of internal control, and this allows for changing business objectives, or changing business environments, identifying acceptable levels of risk, and supporting decision-making and governance. If you notice on the right side, sorry, my slides got messed up there. If you notice on the right side, you can see the organizational structure of the entity, and so this defines the areas within the organization that are impacted by internal controls. The key takeaway here is just to recognize that it covers all areas of the business: entity level, division, operating units, and functional. So The key objectives of COSO allow businesses to align their controls with the various objectives of the business. And these objectives are operations, reporting, and compliance. Operations objectives pertain to the effective and efficient use of resources and the safeguarding of assets. Reporting objectives relate to internal and external, financial and non-financial objectives and requirements. It focuses on the reliability, timeliness, and transparency around all types of reporting. So an example of this might be your financial statement audit or reporting on specific budget items, etc. And then the last one is compliance. Compliance objectives relate to adherence with laws and regulations. So examples of this could be HIPAA compliance, PCI compliance, or HR policies and procedures. And you'll notice that SOX is a very small piece of this, so internal controls really do affect all parts of the business, not necessarily just financial reporting. According to COSO, the 5 components provide an effective framework for describing and analyzing the internal control system implemented in an organization. So these are tone at the top, control environment, risk assessment, control activities, information and communication, and monitoring activities. So the control environment sets the tone of the organization and influences the control consciousness of its people. The control environment factors include integrity, ethical values, management's operating style, delegation of authority, as well as processes for managing and developing people in the organization. Every entity faces a variety of risks from external and internal sources that must be assessed. So the risk assessment is a prerequisite for determining how these risks should be managed. The control activities are the policies and procedures that carry out management's directives. The control activities occur throughout the organization at all levels and in all functions. Information and communication. So IT systems play a key role in the internal control systems that produce reports. And effective communication must ensure that information flows down, across, and up the organization. And lastly, monitoring. Internal control systems need to be monitored, a process that assesses the quality of the system's performance over time. The 17 principles were developed to assess these 5 components and ensure that they are present and functioning. I'm not going to go into a whole lot of additional detail on this, but I think it's important to have an overview of this framework as we start to think about the control environment. As we move into our discussion about controls, we have discussed the reason for controls is really to drive effective and efficient processes and meet specific objectives of the business. By designing and performing controls, management is building a framework to make representations to its end users that specific objectives have been achieved. As it relates to financial reporting controls, there are specific representations that management should be able to make based on its internal control structure. Existence, occurrence, and validity. So are the recorded transactions real and properly dated? Rights and obligations. Do the transactions or assets belong to the organization? Accuracy and valuation. Are the events that occurred recorded at the right values? And completeness. Are all the events that occurred recorded? Are all the information fields recorded? And now we have our next polling question.
So please select the answer that best completes the following sentence. The control environment at my organization is overkill. Our controls take up too much of our time. They could be enhanced. There are areas where I feel risks are not mitigated sufficiently. They're just right. We have an ideal balance of effectiveness and efficiency. Please select the radial button next to your answer and press the Submit button. Also, if you are having trouble viewing the polls, please let us know using the Q&A feature. And as a reminder, we want to encourage everyone to ask any questions that you might have, and we will either get to them throughout the presentation or answer them at the end, but we love questions, so please don't hesitate. And we'll go ahead and close the polls and take a look at our results.
Okay, so as a little surprise here, I did not expect 36% to have what I like to call the Goldilocks just right scenario, but it's always great to see what everybody has. And of course, I did expect that many people who were participating in this webinar would want to see their control environment enhanced. Which brings us to our topic today, which is what we are calling, as Erin said, SOX squared. So for the individuals on this call who are from a public company, and also for those of you from a private company, we do want to help you all understand that internal controls and SOX really isn't checking a box, and there is a lot of value that can be derived from your internal control environment. When I think of the value that can be added, I think of efficiency and effectiveness. Efficiency and effectiveness are the keys to delivering value to your organization and improving oversight and business performance on a wider scale. We have examples that Erin and I will be sharing with you today. The examples will cover the areas of segregation of duties, fraud, preventive and detective controls, analytics, accounting close, and ITGC effectiveness. So let's get started. Our first example today is segregation of duties, or commonly referred to as SOD. What is segregation of duties? The COSO definition of segregation of duties is dividing or allocating tasks among various individuals, making it possible to reduce the risk of error and fraud. But really what we are talking about here is more than one person is required or able to complete a function or task. So why segregation of duties controls? Segregation of duties is a critical element of internal controls. You will see in our next example how lack of segregation of duties can create an environment ripe with fraud. Think of segregation of duties activities as a system of checks and balances. The U.S. government has three branches: the executive, the judicial, and the legislative. This is so that one person doesn't hold all the power. This is our government's application of segregation of duties. It is vital in preventing fraud, and it helps reduce or prevent errors. Segregation of duties is necessary for organizations of all sizes. You may be thinking, segregating duties at my organization is impossible. We are too small, and it's just not going to happen. And I agree that it's quite challenging. But what's important is that we think outside the box. Why couldn't a HR admin or a receptionist be responsible for entering and validating a new vendor? There may be some training required, but there's value in mitigating that risk, which could be that a fictitious vendor is added to your vendor log. So thinking outside the box is a critical element in addressing segregation of duties at organizations of all sizes. Let's talk through an example. Here, we have an accounting manager. We are going to call her Lisa. Lisa has a lot of responsibilities in her role. She's responsible for inputting the invoices that are received from vendors. She also processes the checks that go out to pay these vendors. You guessed it, she also can add new vendors to the vendor master file. She also records AP. She trains all of the new accounting clerks. And she reports AP activity up to the controller. This, unfortunately, we can laugh a little bit at this situation, but it's not that uncommon. Proper segregation of duties are not in place. And this company is vulnerable to a fraud. Segregation of duties is critical to effective internal control. It reduces the risk of both erroneous and inappropriate actions. In our last example, Lisa was able to add a vendor and pay the vendor. The approval function, the accounting reconciling function, and the asset custody function should be separated among employees. Segregation of duties is a deterrent to fraud because it requires collusion with another person to perpetrate a fraudulent act. If duties were properly segregated at Lisa's company, she would need to collude with the person in charge of the vendor master file to pay a fictitious vendor. Our next example is fraud. So we have here today kind of a fun example here. A poll from Fast Company stated that 82% of executives admitted to cheating on the golf course. And Erin and I are certain that that's not anybody on this call today. But on a lighter side, or on a more serious note, the fact is that companies lose about 5% of revenues annually to fraud. So understanding controls that can reduce the risk of fraud is really a money saver for your organization. The fraud triangle is one of my favorite visuals for talking about fraud. It really explains the reasoning behind and how workplace fraud can and may happen at your organization. The first element is opportunity. This is the means by which the individual could defraud the company. This could be, like in Lisa, our last example, a lack of segregation of duties at your company. The second element of the fraud triangle is pressure and incentive. This is the motivation behind the crime. And it could be personal financial pressure, perhaps personal debt or gambling debt. And the third and final element of the fraud triangle is rationalization. This is where the fraudster justifies the crime in a way that is acceptable to his or her moral compass. And it may be a need to take care of a family or a feeling that that person is owed something by their organization. So let's talk about types of fraud. Fraudulent financial reporting. This could be inflating sales at quarter end in order to make a revenue goal. Misappropriation of assets. Expenditures and liabilities for an improper purpose. Revenue and assets obtained by fraud. So this could be a bribe. And, of course, senior management financial misconduct. So how do we implement controls to reduce the risk of fraud? Internal controls are key to preventing or detecting fraud. Controls are needed to ensure that duties are properly segregated, system access and super user access is restricted and changes are monitored, susceptible assets are safeguarded and inventoried, and bank account signers are limited and appropriately segregated. It's important to make sure that preventive controls are properly assigned to prevent fraud over key risk areas, and that detective controls are in place for residual fraud risks. We will talk more about preventive and detective controls in our next example. Which brings us to prevent and detect controls. Prevent and detect controls can bring value to your internal control environment. Both types of controls are essential to an effective internal control system. From a quality standpoint, preventive controls are essential because they are proactive and emphasize quality. However, detective controls play a critical role providing evidence that the preventive controls are functioning and preventing losses. It's really all about finding the right balance between preventive and detective controls that works best for your organization. I'd like to share with you a few examples of prevent controls that we have seen in organizations. Segregation of duties. We've talked a lot about this today, but having proper segregation of duties in place at your company is one of the strongest preventive controls that you can have. Training staff on applicable policies and procedures. This seems like a no-brainer, but your staff should understand what the policies are and making sure that those policies are in place and shared with your team. Proper authorization. So an example of this is a spending authority matrix or perhaps a purchase order system control that would automatically route a purchase order to the proper approval based on the value of that purchase order and the spending authority matrix. Physical control over assets. This could be a security alarm system. So the next is detective controls, and some examples of detective controls are exception reports, account reconciliations, counts of physical inventory, and budget to actual analysis. These are all items that detect and correct undesirable events that may have occurred. So what are best practices for prevent and detect controls at your organization? It's really about finding the right balance. You do not want an environment of all prevent or all detect controls. It's really important to look at what is best for your organization and what works best with the systems that you have in place. Proper assignment of roles and responsibilities, both manually and in the system, granting user access rights, and looking into role and user change controls.
We have our third polling question. True or false? Having all preventive controls is key to an efficient and effective control environment. I think, Mandy, you just gave that away. We do have some great questions coming in, so we'll save those for the end and make sure and get them answered for you. And we'll give this just another few seconds so we can make sure everyone has had a chance to answer it, and we'll go ahead and close the polls. So be sure and get your answers in. And let's take a look at our results.
All right, so about 3/4 of you are listening. Just kidding. The correct answer is false. As Mandy mentioned, you really should have a good balance of preventive and detective controls in your organization. Another key concept that can help provide a lot of assurance over financial information is the frequent preparation and review of analytical analyses. This is conceptualized by creating a monthly or quarterly review of revenues or expenses as compared to budgets or prior period actuals, or both. Specific examples of controls include management reviews the P&L variance analysis for accuracy, consistency, comparability, validity, reasonableness, and completeness to ensure that the financial statements are prepared in accordance with GAAP and the company's accounting policies and procedures. Another example of a control over analytics that's maybe a little bit shorter would be that management reviews the monthly budget to actual analysis, including explanations of all variances. In a public company environment, these are considered management review controls and should also identify thresholds for acceptable variances, generally a dollar amount and sometimes also a percentage change period over period. So some of the risks that having controls over analytics might help us mitigate would be that correct postings are not made to the proper account. Company personnel may make investment decisions contradictory to the company's direction and expectations. Revenue or expenses may be inaccurately recorded, and account balances that require adjustments or related adjusting journal entries are not identified during the accounting period close. So there are a lot of good benefits to having this control, and I think this is one that's really key to have in any organization. It can identify if your expenses are too high or too low. A good example of this would be if your payroll expense changes period over period, or if it doesn't change period over period. For example, if you have an employee that was terminated, but your payroll costs did not decrease month over month, then you may question that and say, wait, based on my experience and my knowledge of the business, I know that our costs should have gone down because we had a terminated employee. It's a really quick way to identify something like that. It might also identify maybe if an expense wasn't included, like rent expense. You know you have rent expense every single month, but then one month is zero, then something may have been missed. It can also identify if significant events were not recorded in the proper period, and so it's important to have somebody at a management level with good knowledge of the business performing this review. So I'd like to talk about IT general controls and also IT application controls. Sometimes this can be a little bit scary and overwhelming to people, but it's pretty simple and straightforward, and it's really important to most businesses, especially now because everyone's using systems to perform some form of accounting duties. General controls is a suite of controls that exist over the IT environment. This includes controls over security and access, change management, and IT operations. Application controls are controls that exist in your systems or applications over the input, processing, and output functions. So we're going to focus first on the IT general controls, and then we'll focus a little bit on IT application controls. So examples of the IT general controls would include things like access to company applications is properly approved, user access is reviewed periodically to confirm appropriate access, the development and acquisition of new systems and major changes is documented in a project plan and approved by management, access to migrate changes to production environments is restricted to authorized users, and developers do not have access to the production environment. This is a really key control to have in any organization, because if you have people that can make any change to the system without approved access, then there's a significant risk that errors or fraud can occur. And then the last one here is just that backup jobs are scheduled to back up critical applications data on a periodic basis, and the backup logs are reviewed to ensure that if there's any issues, they're resolved. I'm having a technical difficulty.
Me to advance the slide for you, Erin?
Yes, please.
Here we go.
Okay, so the IT risks that we would cover with IT general controls would include that users have the ability to execute tasks that result in unintentional errors or intentional fraudulent activities that are not detected on a timely basis. Access is not limited to authorized users. Modifications to systems could significantly impact financial reporting. And backups are not performed according to defined standards and are not stored in a secured location. So again, these risks just come back to security and access, change management, and operations. So the benefits of IT general controls would include that you have the ability to rely on systems and applications without manual work, and that you're reducing the amount of manual work that your team has to perform. And then also, there's the potential to reduce the substantive testing during a financial statement audit, which reduces the work of the auditor, but then also reduces the work that your team is going to have to do. So moving on to IT application controls. Examples of IT application controls include that the system restricts the ability to prepare and post a journal entry, or your banking website requires independent initiation and approval of wire transfers, or that the fixed asset system automatically calculates depreciation expense, or the GL restricts the ability to post transactions in a closed period. So you'll notice that these are a little bit different than the IT general controls that we talked about. These would be things where it's just a normal part of a business process. For example, if you have an application control that you're using an automated workflow to approve POs, you can rely on that automated workflow rather than having a manual control that says every single PO has to be approved manually. So the IT application risks are the same risks that would exist in your business process. If you look at the controls that I've listed above, for example, the system restricts the ability to prepare and post journal entries. This would support but not fully mitigate the risk of a journal entry not being properly reviewed. Or the system calculating depreciation would support that the depreciation calculation does not include errors. So the benefits of having IT application controls are really, well, there are several. But reliability, this reduces the likelihood of errors due to manual intervention. An example of this would be the depreciation expense. If the system is automatically calculating depreciation expense based on what's already been entered in the system, then you have a lot more reliability that that calculation has been performed accurately. Benchmarking, reliance on IT general controls can lead to concluding that application controls are effective year over year without retesting. And time and cost savings. Typically, application controls take less time to test and only require testing once as long as the IT general controls are effective. It also reduces the manual resources that your team has to apply in order to perform controls. And then one last thing to note is just that it is important to test your IT application controls at least once annually, especially if you have changes in your systems, just to make sure that any change didn't affect the performance of a system control. Now we have our next polling question.
Thank you. So how many business days on average does your organization spend closing the books? I know we'll be addressing this a little closer in the upcoming slides, but is it less than 5 days, 5 to 7 days, more than 7 days, or you don't know, not certain? And of course, if you're not willing to give an answer, certainly feel free to use that last one. But this is just on average that you're aware of. We're no right or wrong answer here. So this is our fourth and final polling question. We'll give this just a few more seconds and we'll close the polls and take a look at our results.
All right, so it looks like most of you are in the 5 to 7 days or more than 7 days to close your books. So that kind of leads us into our next topic, which is accounting close, and specifically fast accounting close. This is our final recommendation, but it's not so specific around controls, but rather overall process improvements to create efficiencies. A fast accounting close is a process that is developed to close the books in a short amount of time in order to meet reporting deadlines. Defining and speeding up the accounting close process, including incorporating controls, can help ensure that the process operates effectively and efficiently. The only control that I've listed here is that a month-end close checklist is prepared and used to ensure proper cutoff, completeness, consistency, and accuracy of accounting records in accordance with GAAP. I've only included this control because I think we all know all of the accounting close controls, that are really important: balance sheet account reconciliations and journal entry reviews. But this one would really help a company that maybe takes longer to close their books identify some of the requirements to close the books, identify timelines for that, and also identify the appropriate people who should be performing each activity. So having this defined process and utilizing a checklist will allow you to identify your objectives and work toward them each period with a little bit more ease. So some of the benefits. I think the biggest benefit to having a fast accounting close is that you're able to get historical information out to your managers more quickly. This will allow the business to make better decisions, to better forecast, and overall just respond to the operations of the company. For example, if it's the middle of February before you can close your January books, you might be 2 weeks past the end of the month before the rest of the company receives any financial information on revenues and expenses and is able to respond to it. So the quicker you can get that information out, the quicker the business can react. Some of the other benefits would be that accounting has more time because they're only spending a short amount of time closing the books, that it would allow them to become more involved in the operations and some of the decision making in the business. and then also would just free up some of their time to support other value-add projects throughout the business. So some of the best practices include process controls, system or application controls, and also an overall review of the process to identify opportunities to speed up this process. These could include creating a closing checklist or calendar, automating posting of subsidiary ledgers, identifying recurring journal entries and opportunities to record those entries earlier or before the period end, defining and organizing your general ledger account, identifying the timing and performance of reconciliations, reallocating responsibilities. I've seen a lot of companies that are small and have a controller that performs all of the account reconciliation reviews. And if there's 3 people in the accounting department, maybe somebody in the middle could review some of the more straightforward account reconciliations like AP. And then automating various closing activities. So I think Mandy and I kind of sped through this. This is our last slide. And just some key takeaways that I think are really important from this. Internal controls based on stated objectives and goals provide the map to help ensure that business activities are not derailed by employee errors or intentional acts of fraud. Regardless of whether your company is publicly traded or privately held, the value of internal controls to process streams is significant both in terms of cash and time savings. Investing in efficient preventive controls saves time and money and reduces the investment in detective controls. As Mandy likes to say, balance is key. So this wraps up the presentation, and I hope that you guys were able to identify some key takeaways and potential controls to implement in your businesses. I think we do have some questions, and we can take some questions at this time.
Great, great. So I have a couple. So one from our Q&A is, who tests the IT application controls annually? Excuse me. Is it management's responsibility, or do you mean independent auditor?
I think it depends on if you're a public company or a private company. But in general, management should be responsible for ensuring that the controls exist and are operating as they're designed. Do you agree with that?
Yeah, I definitely agree. Our focus is really on you all, which is management, and what the external auditors are doing is for their compliance, and our purpose is to help you and give you recommendations on how to improve your business. And I definitely agree with Erin that an annual assessment or test of IT controls is really a best practice. And like Erin said, if there are changes to your system, that should trigger another evaluation.
Thank you. Let's see. So we were also asked, with regard to risk assessments, can internal audit complete then meet with management for feedback instead of having internal audit and management complete too?
Sorry, are you asking if we can do a combined risk assessment?
I think so. I think that's what that's asking.
I think it depends. From the IT side, there might be specific detailed IT knowledge that's required. So it really depends on your internal audit's comfort and knowledge of IT environment. So I can see value in having 2 separate risk assessments, or really one holistic risk assessment that would pull in an IT expert.
Mm-hmm. And now I'm seeing the rest of this question. Can internal audit complete jointly with management a risk assessment? Absolutely.
It's not internal audit's responsibility to really do the risk assessment. It's really management's, and internal audit generally facilitates the process, but management owns the processes and the controls. so they should be aware and ready to discuss and evaluate the risks.
Great, great. We had one more that asks if you could review what's required with SOX versus COSO, and I know that would be kind of lengthy and maybe its own webinar in its own right, but is there a summary that you could provide with that, what the primary differences are between SOX required versus COSO?
So SOX requires that management use a framework for its internal controls, and really it doesn't have to be COSO. COSO is just the most widely accepted framework. I think what maybe this person is pertaining to is that really what happened when COSO came out with the new framework in 2013, they really, a lot of our clients, we saw that the external auditors really pushed a lot of the COSO elements to be key controls. And in my personal opinion, I don't agree that all of those COSO 75 points of focus really needed to align to a specific key control. I don't believe that was the objective of the COSO framework. However, what happened was the external auditors, in order for them to evaluate it, they really pushed that companies create those elements as key controls. And in the end, it was really what we saw is most clients of ours went from maybe 10 to 15 entity level controls upwards to 20 to 30 or even more. So really, to answer your question, it shouldn't in theory. However, when we're working with our external auditors, we want to make sure we add value, but at the end of the day, if the external auditor is requiring that a company have key SOX controls to map to all of the COSO elements, then that's where we landed there. But theoretically, that wasn't the purpose of COSO. It's really that those elements should be in place.
So there are other frameworks that could be used as well?
Sure, yes, but COSO is the most widely accepted.
Wonderful, wonderful. Well, thank you so much, Erin. Thank you, Mandy. We appreciate all of your information. And thank you for joining us today. Should you find you have additional questions, let our presenters answer those for you. They're glad to have a conversation. Send them an email, pick up the phone, challenge them to take you to lunch. So thank you again for joining us.
Thank you.